Welcome back to AlgoBot, the channel where we take apart automated trading strategies and study how they think. I'm your host at AlgoBot, and today we're exploring an expert advisor for MetaTrader 5 called Volume Index Conviction Trend. This strategy is built on a classic volume idea from Norman Fosbach and Paul Dysart, the positive and negative volume index, which tries to separate quiet, informed participation from noisy, crowded activity. Over the next few minutes, you'll learn how it reads volume, how it times its entries and exits, and how the code behind it actually works. Just remember, this is educational information only, not financial advice. Let's get started. So what does this expert advisor actually do? At its heart, Volume Index Conviction Trend splits the market into two crowds based on participation. The core idea from Fosbach and Dysart is simple but clever. On a busy bar, where tick volume rises compared with the previous bar, the uninformed public tends to dominate the flow. On a quiet bar, where tick volume falls, informed participants, often called smart money, can trade without a crowd around them. The strategy builds two running indices to keep track of these two groups. The negative volume index, or NVI, only updates on quiet bars, so it reflects what the informed side is doing. The positive volume index, or PVI, only updates on busy bars, so it reflects the crowd. Both start from a base value of 1,000 and grow or shrink with each bar's percentage price change. Fosbach's observation was that when the negative volume index trades above its own long-moving average, a bullish backdrop is strongly favored because the quiet, informed money is accumulating. When it trades below that average, the picture leans bearish. This expert advisor treats the negative volume index as the primary, higher conviction signal, and it uses the positive volume index only as a confirmation, so it doesn't fight a crowd that is stampeding hard the other way. On top of that, every trade is protected with a stop loss and a take profit sized from the average true range, so risk is defined the moment a position opens. Its natural habitat is a liquid currency major like euro versus US dollar on an intraday time frame, such as 15 or 30 minutes. It suits a trader who is curious about volume-based, trend-following logic, and who wants clearly defined, rules-based entries rather than discretionary judgment. As always, trading involves real risk, and losing trades are a normal part of any approach. Let's walk through the logic step by step. On every newly closed bar, the strategy first looks at whether tick volume rose or fell compared with the previous bar. If volume fell, it treats the bar as quiet and updates the negative volume index by that bar's percentage price change. If volume rose, it treats the bar as busy and updates the positive volume index instead. This means each index moves only when its own crowd is active. The strategy then advances an exponential moving average of each index, using the SignalPeriod parameter, which defaults to 40 bars. These smoothed averages act as the reference lines that the raw indices are measured against. Now for the entries. The strategy detects a long setup when three conditions line up together. First, the negative volume index crosses from at or below its EMA to above it. That's the smart money regime turning up. Second, the index is genuinely rising on that bar, confirming the move has momentum. And third, the positive volume index sits at or above its own EMA, meaning the crowd is not actively pushing the other way. When all three agree, the EA signals a buy. The short setup is the mirror image. The negative volume index crosses from at or above its EMA to below it. The index is falling, and the positive volume index sits at or below its own EMA. When those align, the EA signals a sell. Exits are handled with equal care. If the strategy is already long and an opposite short signal appears, it closes and flips to the new direction. If the negative volume index simply crosses back below its EMA without a full new signal, the regime is considered lost and the position is closed flat. The same rules apply in reverse for a short. And behind all of that sits the hard backstop. On entry, the strategy measures the average true range over the AtrPeriod, which defaults to 14. The stop loss is placed at SL multiple times that range, defaulting to 2, and the take profit at TP multiple times the range, defaulting to 3. That gives a reward to risk shape of 1.5 to 1 on the default settings. Position size is fixed by the lot's input at 1/10 of a lot by default, and it trades one position at a time. Let's read through the code as it would appear in MetaTrader. At the top are the input parameters you can adjust in the strategy tester. SignalPeriod sets the length of the EMA applied to both volume indices. AtrPeriod controls the average true range used for stops and targets. SlMult and TpMult are the multipliers that turn that range into a stop-loss and take-profit distance. Lots fixes the trade size, and magic is the identifier the EA uses to recognize its own positions. Below that is the signal block. The Boolean cross-up is true when the negative volume index was at or below its EMA on the previous bar and is now above it. Cross-down is the opposite. The rising and falling flags confirm the index is actually moving in the signal direction, and the two PVI flags check whether the crowd's index is on the same side. Go long is only true when the cross-up, the rising index, and the bullish PVI all agree together. Go short mirrors that exactly. Now look at the buy branch. When go long is true, the strategy reads the ask price as the entry, sets the stop-loss below it at SL multiple times the ATR, sets the take profit above it at TP multiple times the ATR, and calls trade.buy. The sell branch does the reverse. It reads the bid as the entry, places the stop above and the target below, again scaled by the ATR, and calls trade.sell. So both sides share the same volume-driven signal and the same volatility-based risk framework, just pointed in opposite directions. Let's bring this to life on the chart. In the lower panel, you can see two lines. The gold line is the negative volume index, our smart money gauge, and the blue line is its exponential moving average. Watch how they interact with the candles above as the setup unfolds. The signal we care about is the gold line crossing through the blue line. Look at the first three candles. Price is drifting lower, making a series of small red bars, and down in the subpanel, the gold negative volume index is sliding underneath its blue EMA. That tells us the quiet, informed money has not yet stepped in. There is no reason to buy while the index sits below its average. The strategy simply waits and lets the market show its hand. Now watch the fourth candle, where the buy entry marker appears. Price turns up and closes strongly higher, and at the same moment, the gold line pushes up through the blue line from below. That's the crossover the strategy is built around. The negative volume index has crossed above its EMA. It is rising rather than just wobbling, and the crowd's index is not opposing the move. All three conditions agree, so the EA signals along. The entry is taken at the buy marker, with a stop-loss placed below at 2 times the average true range and a take-profit set above at 3 times that range. From there, follow the next few candles higher. Each one builds on the last, printing higher highs and higher closes, while the gold line stays confidently above its blue average. This is exactly the environment the strategy is designed to ride, a quiet accumulation that keeps pushing in one direction. By the 7th candle, price reaches the take-profit target and the long trade is banked at that upper marker. Notice we never speak an exact number here, because those levels aren't printed on the chart. We're reading the structure, the buy marker, the run upward, and the take-profit target. Now the picture shifts. On the 8th candle, price stalls at the highs and reverses into a firm red bar. Down in the subpanel, the gold negative volume index rolls over and cuts back down through its blue EMA. That is the mirror image signal. The index has crossed below its average. It is falling, and the crowd's index is on the same side. So the strategy signals a short at the sell entry marker. The stop loss now sits above the entry, again at 2 times the range, and the take profit sits below at 3 times the range. Follow the final candles down. Price steps lower bar after bar, while the gold line stays pinned beneath its average, confirming the informed side has flipped to distribution. By the 12th candle, price reaches the lower take-profit target and the short trade is closed. Across both trades, the pattern is the same. The strategy waits for the volume index to commit through its own average, confirms with a rising or falling index and a supportive crowd, and defines its risk with the average true range. That reward to risk shape of 1.5 to 1 on the default settings is what the strategy aims for on each clean signal. Of course, not every crossover leads to a move like this, and that is why the stop loss is always in place. And that brings us to the end of our look at volume index conviction trend. Today we explored how Fosbach's negative and positive volume index separate the quiet, informed money from the busy crowd, how the strategy signals a trade when the negative volume index crosses its own moving average with confirmation, and how it defines every stop loss and take profit using the average true range. We also read through the core MQL5 code and watched a long and a short trade play out on the chart. Remember, everything here is educational content only and not financial advice, a recommendation, or a solicitation. Trading carries real risk, and losses are part of the process. If you found this helpful, please like the video, subscribe for more MetaTrader 5 strategy breakdowns, and drop a comment with the strategy you'd like us to study next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.